Forensic Forex with Deontay, and I'm back in another video. This is example 5 to the IPDA data range library. As you can see, we're looking at GU in the month of March, and we're just going to break it down. So like ICT says, I'm going to come to the first of the month, going to look back 20, 40, and 60 days. And in each one of these 20-day quadrants, I'm going to find the highest high and lowest low in each one. So that's the 20-day high, that's the 20-day low, the 40-day high, that's the 40-day low, that's the 60-day high, and that's the 60-day low. At that point as well, I would like to cast forward 20 days because I know within 20 days, the market's going to be reaching for another liquidity pool, or it's going to mitigate one side of a liquidity pool and then run towards the other. There's sell side liquidity below the 20-day low, buy side liquidity above the 20-day high, relatively equal highs or double tops here, buy side, buy side. This is an old low. It's been broken here. There's sell side liquidity below the 40-day low. So I have areas of interest where the market may reach. You also have the opening price for the month, which is here. And we know anything above the opening price is a premium. Anything below is going to be a discount. The commercials like to buy in a discount, and the commercials like to sell in a premium. Now, if we know the daily draw or the monthly draw, we can probably suspect what price is going to do around this opening price. If we're suspecting price is going to trade down for the rest of the month, we would want to see price come above equal highs and above the opening price and sell lower. If we're suspecting that price is going to go up for the month, we're suspecting it to drop below, make a fake move on retail traders below into a discount, and then run higher. So we'll play it out just to see what happens. Today is currently March 31st, and you can see price comes down, takes out sell side liquidity, clean lows here, ran, old 40-day low, sell side liquidity, ran, old 60-day low hit as well. At this point, they are convincing retail traders that it's probably going to go lower. Price may go lower, but that may not be the overall trend. This just may be a false break. And if you play price forward, you can see it comes up, right? Rallies back through from being below the opening price. They create a swing low formation below the open. And at this point, we can tell that the commercials most likely sponsored their buy positions in these down closed candles here. And now it's pushing price back higher. What could they be aiming for? Equal highs. You see these highs here, these swing highs here, or the primary objective, the IPDA look back 20-day high here. And if you play it forward, price comes back down, hits a sensitive price point here, comes back to the opening price, dips below it. Now there's also PD arrays here. I won't mention them here, but there's also other PD arrays and confluence here to tell you that this is probably going to be some sponsorship of buying will come in here. Price also hits the opening price, which is a sensitive price point, fair value. Anything below it now is discount. You see how it taps into a discount one more time before going higher. And price takes out buy side above swing highs here, here, and it still was pushing for that up there as well. And that's where we are currently in price. You can see it hits the 20-day high after taking out the sell side liquidity. So this example looks like the previous examples that I posted on this series. This is normally the bread and butter setup that I'm looking for using IPDA. Taking one side of sell side, then running back to buy side, or vice versa. Taking buy side and then running to sell side. But obviously, you have to do your homework and you have to do your macro analysis, your fundamental analysis, your technical analysis to come to a decision whether or not this month is going to go up or go down. Hopefully this was insightful. Peace.